news, and also exactly is it. Usually, researchers they are motivated by some kind of say existing theory. So, say for example, earlier I talked about say confirmation bias. It can be some kind of the theory that is generated from say psychology or let's say sociology, and then we want to say apply such kind of the theory in existing world to see whether we can explain some of the investor behaviors we observed from our daily life. And then the major difference between explanatory model and predictive model is that for explanatory model, usually we establish a lot of say hypotheses. So we want to see whether the underlying empirical data actually supports the hypothesis we establish. So the major say parts of the explanatory model related paper is that we are interested to understand the relationship of some of the causal factors in the theoretically driven model. And then we want to make use of some statistics to understand whether the strength of the relationship is significant or not. The second stream of research, it is related to the use of say predictive model. Now it is a bit different from explanatory model. We are not interested to say understand what is the underlying factors that drive to certain kind of investor behavior. Instead, what we are interested to know is that whether we can make use of the existing model to say predict for some future new observations. So in the context of say investor communities, what we are interested to know, of course, it is say future stock returns or say future earnings announcements, and then we want to know the outcome of the earnings in the future. So here the objective it is to see whether our prediction generated from the predictive model, whether it is good or bad, whether it can help us to say find out the future values of say stock returns or say earnings. So that is the major objective. And actually, these are the two major difference in terms of the outcome between explanatory model as well as say predictive model. So the objectives are different. For explanatory model, we want to know the relationship of different constructs in a theoretically driven research model. For predictive model, we are interested in the prediction outcome. In the subsequent slides, I'll give you more examples so that you can understand in a better way the differences between the two. So some people, they may ask, is explanatory the same as a prediction? There are some norms people they may hold that if a model can explain, then it can predict. True, to some extent, a good explanatory model can predict some outcomes. However, there are also some kind of the differences between the two types of the model. First, explanatory, the major purpose it is to understand the underlying causes. Okay, so it is very different from the outcome of the prediction. So when people they develop some kind of explanatory model, they are not their primary objective to say identify prediction outcome. Instead, what they understand the underlying causes that may drive different kinds of the phenomena. Okay, so actually the objective they're different. So as a result, there are some kind of the difference between explanatory model as well as a prediction model. But no doubt that there are some kind of relationship between the two, because if you can understand the underlying causes of a certain kind of the phenomena, then we can make use of the results to say make a better prediction in the future. But it is not necessarily true all the time that actually prediction it is equivalent to explanation, because the two of them they are actually to some extent different from each other. Okay, so what does it mean by explanatory model? Basically, explanatory model involve identification of causal factors. So what are the factors that drive certain kind of, say, investor behaviors? So in order to answer this question, it is necessary to, say, develop some kind of, say, hypothesis. So we usually have some null hypothesis that we can use some statistical tests to see whether we can reject the null hypothesis. This is what we call inferences. So we want to, say, make use of the empirical data to see whether some causal relationship exists in our, say, research model. As for the predictive model, the major difference is that we are interested to predict some new outcome. So based on the existing data, we want to know what will happen, let's say 1 week or say 1 month later when a firm makes an announcement related to its earnings. So what we are interested to know is how good the predictive model is in terms of its prediction performance. And then sometimes there may be some problem that may occur, which is what we call overfitting. That is, the model can only be useful to predict for old data, but not good for predicting new data. That is what we call, say, overfitting. So we want to understand whether there is any performance or, say, any overfitting issue in our existing predictive model. And then predictive model, sometimes it is also good to generate some new theories. So by observing, say, the relationship between various variables and also outcomes, it can actually help researchers to, say, understand whether there exists some new phenomena and whether it is possible to use some theories to, say, explain some new phenomena that is not available in the existing, say, theories. And then we can also use, say, predictive model to develop some kind of the measures to measure some new constructs. And then we can also assess the relevancy of, say, the various, say, variables in predicting some of the outcomes that we are interested in. So if you are interested to know more about the differences between explanation and also prediction, you're welcome to, say, see a paper by Shomuli and Kopias that appeared in MIS Quarterly in 2011. Okay, in terms of say assessing, say in terms of assessing whether a model is good or bad, actually we use different kinds of say features for the assessment. Say for example, in terms of explanatory model, what we are interested in it is its explanatory power. So if we are interested in hypothesis testing, and if you know some statistics, what we are interested to say understand whether a variable is significant in explaining certain say outcome variable, we are interested to use a p-value. For the overall models, if we want to know its goodness of fit, one of the measures that we are interested to use it is say R-squared. And of course, there are some other statistics, say variables that we are interested to say measure that include type 1, type 2 errors, so that we can understand whether we say accurately say accept a hypothesis, or say we incorrectly say accept an hypothesis. So we can make use of different kinds of the statistics, say variables, to understand the explanatory power of say an explanatory model. For the second type of say research, which include a predictive model, we are interested in the prediction accuracy. So when an earnings announcement occur, and then we can actually compare our predicted earnings and also the actual earnings, and then we can compute the prediction accuracy by looking at the difference between the prediction and also the actual outcome. We can also see whether there is any overfitting issue by actually comparing the prediction outcome and also the actual outcome. And then we can actually understand better whether our underlying predictive model is good or bad. Now, in a nutshell, what is explanation and what is, say, prediction? Actually, if I use the case of, say, food delivery, for explanation, actually, it is more like the green bubble, which is what causes customers not paying. For prediction, actually, it is something that is concerned by a lot of, say, the delivery guy as well as companies. One of the related question is whether the customer will actually pay. So these two, they have different objectives. And then because of that, actually, in terms of, say, methodology, we observe in existing, say, research, they also varies. So in terms of, say, prediction, what we are interested to know is that whether our underlying model, it is accurate in terms of prediction, and whether it can help us to, say, identify, say, the outcome accurately. It is very, very different from explanatory model. The goal is to identify whether the model, the underlying model that constructs the relationship between constructs that are actually true. Actually, in existing IS research, many of the papers that we observe, they are actually in the field of, say, explanation and prediction. It is actually underappreciated. But actually, we observe that over time, there are more and more prediction-related papers that appear in, say, the research community. And in the subsequent, say, slides, I will actually show you, say, both types of the research so that you understand more, say, the current trends of research using both kinds of the models. Okay, so first, let's talk about some explanatory model. Okay, so before that, as I said earlier, usually explanatory model, they are driven by existing theories. So there are two theories that exist in the field of, say, online investor behavior. And I would like to explain a bit about what they are. And then later we will discuss a paper published by, say, Park et al. In Information System Research that look into the phenomena of confirmation bias and also overconfidence. So what does it mean by confirmation bias? So basically, a lot of people, they may hold some of their prior belief, and then their prior belief is very strong. When they observe some, say, incoming messages, what happens is that they choose messages that favor their initial belief and discard other kinds of the messages, or say ignore other kinds of messages that are different from their own belief. This is what we call, say, confirmation bias. In the context of, say, online investment, because online communities, we can see a lot of messages from different, say, social media platform, online news. There are lots of, say, incoming messages. If certain investors, they have some prior beliefs, then they will actually preferentially treat some messages that supports their ideas. They support their prior beliefs. Such kind of the phenomena, it is what we call, say, confirmation bias. There is another, say, theory, which is what we call, say, overconfidence. And it happens very frequently in the field of, say, online trading. So what it happens is that investors, they tend to trade more and more actively because they hold extreme confidence towards what they believe. And then they expect that actually when they trade more, say, frequently, then there will be, say, higher market returns. So because of such kind of the belief, they keep on, say, trading based on the belief, and they unrealize that actually it is not guaranteed that they will be able to, say, make a higher returns. This is what we call, say, overconfidence. Okay, now understanding, say, both types of the theory, the next step usually in the behavioral research is that we will try to establish some kind of the explanatory model to understand the investor behaviors, especially in the, say, online context. So actually, Park et al., they conducted a very large-scale experiment in Korea, and then that involved, say, 502 investors who participated in the field experiment related to, say, some messages they display on an online message board. Okay, so this is, say, their explanatory model. So usually we derive a model based on existing, theory. Say, for example, confirmation bias as well as, overconfidence. So based on the theory, the researchers actually, they developed some kind of, explanatory model that involve different constructs. And they hypothesize the relationship between the constructs. Say, for example, the strength of beliefs, that is how strong individuals, they hold their initial belief, and also confirmation bias. They actually hypothesize a positive relationship between them. They can also develop different kinds of the hypothesis related to, let's say, the trading frequency, the returns based on the overconfidence theory. Okay, and then they can develop the whole research model based on existing theories. Now, back to my earlier introduction. How do you evaluate such kind of the explanatory model? One way for you to demonstrate the accuracy of the explanatory model, it is to use some underlying data to see whether the underlying data actually fits the research model, which is in the form of explanatory model, and show that it is what they hypothesize. So you can make use of some empirical data to demonstrate the reliability or the accuracy of the explanatory model. So here, Park et al. Actually what they do is that they run a few experiments. So in one of the largest stock message board in Korea, what happened is that they first invite participants based on what they post on the social media. So they know what messages they have posted, and then they develop different kinds of the messages. Some of them, they fit, the participants, initial belief. Some of them, they counter the initial belief, and then see what kind of the messages the participants, they're likely to click. So according to confirmation bias, people, they usually click on messages that favor their own belief and discard all those, messages that counter their initial belief. So based on the experimental results, basically, the researchers can see whether confirmation bias exists in the online community. And also, another thing they do is that they will ask how much they are going to invest in certain kind of the stock after reading the messages. And then they can compare the actual outcomes of such kind of the artificial trading of the participants, and see whether overconfidence will actually create some kind of financial loss to participants. So they can make use of that kind of the experiments, generate some data, and then see whether the explanatory model they created earlier, it is accurate or not. Okay, so actually what they find out is that this predictive model, it is accurate. So if individuals, they have a higher initial belief, then the confirmation bias is getting more and more serious. And what happened is that people, they will trade more frequently, and as a result, the return gap, which is the actual earnings that they receive and also the expected earnings that they actually gain, it is negatively related to the confirmation bias. And then throughout the experiments, they also control for different, demographic information like age, gender, the time they spend on the online community, their income, education, etc., to make sure that there are no other confounding variables that influence the outcome. So based on the empirical data, they demonstrate, the accuracy or the reliability of, the online investor behavior model. Okay, another paper I would like to discuss with you guys. It is related to whispers or some kind of the rumors in the online community. So for those who are interested to know more about the paper, you can read the paper by Bengali et al. Published in Journal of Accounting and Economics, and also Van Bomer, a paper published in the Journal of Finance. So what happened is that actually what we observe nowadays is that a lot of the time people they communicate in online communities, and oftentimes there are some say private information or say some secret news that appear on say online communities. It is what we call whispers. So one interesting research it is to see whether whisper actually it performs as good as say some professional analysts forecast. So what the researchers they do is that they actually compare the whisper forecasts and compare it with some of the analyst forecasts, and then see which one it is say more accurate. And then actually what we find, what the researchers actually find is that whispers to some extent they are more accurate than say market explanation in terms of say predicting say the earnings. Now, some of you may wonder why, what drives that kinds of, say, the phenomena. Actually, in one of the limitation of predictive model like this kind, because it is not theoretically driven, so actually, usually, the underlying phenomena, it is not known. However, if we observe some interesting, say, findings from the predictive model, say, for example, whispers, it is better than analyst forecasts, then it is very likely that researchers in the future, they will generate some kind of the theory to explain the underlying phenomena. Now, I can tell you that why whispers, it is better than analyst forecast. One of the major reasons is that sometimes analyst forecasts, they are biased because analysts, to some extent, they also represent, say, some of the companies. And then they want to say sell the stocks of some companies, especially some investment banks. Analysts, they are responsible for say selling some IPO stocks to say customers. So actually, to some extent, what's fun is that a lot of the time, analyst forecast it is biased, and it is usually favoring say some kind of say the companies. They are say more optimistic than other people. For whispers, usually on online communities, because the identities of individuals, they are unknown. So what happens is that most of the time, say people, when they talk about some, say, of their insights or say some of the predictions, usually they are not restrained by their own role in the society. So they can be more likely to speak out the truth. So what's fine is that whisper, it is usually better proxy for market expectation of earnings than analyst forecast. The major reason is that people who whisper, they are actually more willing to say, speak out their own thoughts. But analyst forecast, because of the dual role of say the companies that they represent, because they, on one hand, they want to say recommend a stock to customers. On the other hand, they also want to say make good prediction. Because of such kind of the dilemma, they are not able to say make accurate say prediction for earnings forecast. So that's why we observe such kind of the results that whispers on online community. To some extent, it is better than analyst forecasts. Another interesting, research related to online investor behavior, it is what we call a crowdsourced prediction. So a lot of, websites that appear, say, for example, Estimize or, say, predict wallstreet.com. Actually, they allow individuals to go to their websites to make some prediction. So you can predict, say, what is the likely, earnings per share in the coming quarter of a certain company. And to some extent, actually, it is found to be better than Wall Street's, consensus. So IBS, it is actually a database that contains all the Wall Street analyst prediction related to, say, earnings of a company. So a lot of, study, actually, they are interested to find out whether wisdom of crowds, it is better than professional analysts. And the result, if you are interested to know more, you can read the Jamie paper published in Journal of Accounting and Research. What they find out is that the answer is yes, actually crowdsourced prediction is better than Wall Street's consensus. Now, again, you may wonder, why is it the case? So there are a lot of, reasons. Earlier, I think I explained some. some of the reason is that because analysts, they face some kind of say the dual role of their say job. So to some extent, they want to sell the shares of say the company, and they face some kind of the sell side pressure. And on the other hand, they also want to say make some kind of say good prediction. So what happened is that usually analyst prediction, it is optimistic, and then that is what we call they are kind of like biased. And then we have another term for it. We call it lowballing, very optimistic. And then what happened is that because they are usually biased, and then their prediction, it is not as accurate as say crowdsourced prediction. And then another important say characteristics for the higher accuracy of a crowdsourced prediction is that actually it consists of say people who are laymen with different background, with different say experience. And such kind of the diversity and heterogeneity actually favor the generation of wisdom of crowds. And actually, wisdom of crowds consists of, say, various elements. First, you should have a very large, say, amount of people making prediction. Second is that the people, they should have a diverse background. The third one is that they should be independent. And then actually, online community creates such kind of a platform that favors the generation of a good prediction because it actually satisfies all the criteria that I mentioned earlier, like the diversity, independency, and also large in size. So what's fun is that actually with some of crowd generated from crowdsourced prediction, to some extent, it is much better than say professional analyst say prediction in the Wall Street. So this is a website that shows to you, say, how it looks like in, say, a company, say, crowdsourced platform. So you can go to the platform and then Amazon. And then you can actually make a prediction and then see what will be the likely, say, revenue or let's say the earnings per share in the coming, say, quarter. And then the platform will actually aggregate. They will give out an average of, say, the estimate of based on all the user, and then give some guidelines to say a user who say make a prediction before or who use the data for some of their own investment. Okay, now let's talk about another stream of say research. And that one, it is related to, say, sentiment. So earlier, I talked about, say, there exist different kinds of, say, social media platform. And actually, people that write their insights or, say, comments, their expectation related to stocks on social media with hope that, say, it can generate some thoughtful discussion online. And then one, say, interesting research in that area, it is to understand what is the general market perception towards, say, certain stock in the forthcoming, say, physical time period. So to understand the thoughts of, say, individual, say, users, or say, to understand the general users' perception of the prospects of a company, one thing we can do it is to understand the tests that they have written on social media. So research, a stream of research that exists in the field of, say, investor community, it is to use some test mining, say, technique to understand sentiments. We have a name for that kind of the, say, test mining technique. We call it test throw analysis. So a lot of, say, papers exist related to, say, test throw analysis. The common one, it is actually to use some kind of the dictionary to say, understand whether the word used by individuals, they are positive or negative. So there exists, say, some commonly used, say, dictionary. Researchers, they actually use to understand some of the, say, sentiments of, say, individuals. So some of the dictionaries include, say, Harvard Psychology Dictionary, Harvard General Inquiry. Actually, these are some of the, say, dictionary that contains thousands of words that describe, say, the sentiments of individual. So say, for example, if you write something like, I'm excited, or say, I'm happy, actually excited and happy, those are some positive keywords. And then we can make use of, say, the word counts, and then find out your, say, a piece of the post that you put up on social media, whether it is generally positive or, say, negative. And then there are also some kind of, say, modification of the existing, say, dictionaries. One of the reasons is that existing dictionaries, they are more related to, say, psychology, and it may not be suitable for the business context. Actually, some words, say, for example, tax and liabilities, in a business context, actually those words, they're neutral. But if you use, say, Harvard Psychology Dictionary, those neutral words, they are considered to be negative. So what happened is that Nowen and McDonald, they actually provide a new dictionary. And that dictionary actually revised some existing psychology words, some of the vocabularies, if they are considered incorrectly in the business context, then they make some modification of it. And then what happened is that in the year 2011, they actually published a paper in Journal of Finance, and then they list out, say, 2,000 something words that have, say, a negative implication in a financial sense. And then they also demonstrate the predictive power, okay, the predictive power of that kind of the textual analysis of sentiments by applying it to, say, some of the earnings filing. And then see whether such kind of the, say, textual analysis of sentiments can help predict the stock returns of, say, the earnings filing immediately where it is released to the public. And actually, they find out that the predictive model that they develop, it is quite good because the prediction accuracy, actually, it is very high. So what they can claim is that the underlying model, which is based on the textual analysis of sentiments, that is the 200 something words, they're actually accurate in terms of, say, measuring sentiments of, say, users on social media. Or not just social media, it can be applied to any kinds of, let's say, news, or say it can also be applied to any kinds of the reports, anything that is textual. Then they can use, say, the data to actually, they can use their, say, word classification scheme to, say, make some kind of prediction. And actually, Logren and McDonald's, their paper has been widely adopted by various, say, researchers in the field of, say, finance, or say even in information systems, or any kinds of the business research. They widely use that kind of, say, the revised, say, dictionary. So what they find out is that basically by using those, say, schemes or, say, dictionaries to identify investor sentiments, they can actually make use of the sentiments to make good prediction of the next, say, stock, next trading day stock returns. The reason is that because if your scheme is able to, say, measure the general consensus of all the investors in the community, then actually it is a quite representative, say, sample of the investors in general. If you can understand the sentiments of investor in general, then possibly you will be able to, say, build a good prediction model that can predict for the future. And apart from, say, the social media, say some, say, early researcher, they also apply such kind of the sentiment textual analysis scheme to news as well. Say, for example, Tedlock. Tedlock has 2 papers, but both of them, they apply the sentiment analysis on Wall Street Journal articles. And then they find out that there exists some kind of, say, pessimism. That is, if Wall Street Journal article, if it is pessimistic, that shows a lot of negative sentiments, then what happened is that it's very likely that in the following day of the publication of the article, there exists, say, a negative market returns in general. So that is what they call, this is what they call the media pessimism. So if the general news media, if they show some kind of pessimistic view to the future, then it's likely that in the next day, actually the market returns, it's going to below or say going to be negative. But in contrast, actually it doesn't happen for positive words. So if let's say the news media, if they are very positive towards say the future stock, towards say the future market performance, on the next day actually it doesn't show up extremely high market returns. So that's something interesting, and it is say worthy for say more researchers to investigate the underlying reason. Now back to my earlier discussion. Actually, say exploratory model and predictive model, their focus are different. So for predictive model, we are actually interested to know whether the prediction outcome it is accurate. So a lot of the time, we may not be able to identify some explanation to explain some of the prediction outcome. And that it requires some additional work to understand the underlying phenomena by building some new theory. So predictive model, it may not be good for explanation, but it will definitely facilitate, or say foreshadow some say interesting phenomena that other researchers they can build on in the future to develop some new exploratory model to understand the underlying phenomena. Okay, so probably you may be interested to know more about how to say develop some kind of the sentiment analysis in order to understand the general say sentiments of say users, or say the general sentiments of the entire market. Now, I would like to say introduce to you a paper written by Entweiler and Frank in 2004. It's published in the Journal of Finance. So what happened is that, say, the authors, what they do is that they actually collect data from, say, stock message bots from Yahoo and also Raging Bull, and then they construct different kinds of, say, sentiment index. So one index that they develop, it is what they call, say, bullishness index. Now, before that, I would like to say talk a little bit about the feature of say Yahoo Message Bot in case you're not familiar with it. Actually, on Yahoo Message Bot, individual users, you can indicate whether you want to buy or sell or say remain neutral based on the message that you post. So what Entweiler and Frank they did is that they collect all the messages related to, I think it is Dow Jones stock. So there are 30 stocks in the Dow Jones Components Index. And then look at all the underlying, say, stock messages and count how many of them they actually suggest a buy, how many of them they actually suggest a sell. And they can make use of the bullishness index like this one, take a log value of the ratio of 1 plus number of buy message, and then divided the whole thing by 1 plus the number of messages related to sell. And then they also use an alternative, say, bullishness index, which is simply the ratio between the buy and sell and the led message of buy and sell, and also the total messages of buy and sell. And then based on the bullishness index, they also develop an agreement index. And then what they do is that they try to say evaluate the accuracy of such kind of prediction model, and they predict say the future stock returns as well as say the future trading volume. So what they find out is that actually the bullishness as well as the agreement index, it can only predict market volatility. But in terms of say predicting market returns, actually the impact of such a prediction say model, it is very limited. So it seems that if a lot of say people they disagree with each other, then that means a very low agreement index, then it's likely to lead to an increase in terms of say trading volume. I think it makes sense. Because if a lot of people, they disagree with each other, so some people, they think that, say, in the future, let's say Apple, the stock will go up, and then some people, they think that it will go down because of, say, unexpected, say, sales. And then some people, they are very confident of, say, the launch of the new iPhone. Some people, they are very pessimistic. So there exists a huge disagreement. And then some people, they may sell their existing stocks, and some people, they may want to buy it. So as a result, the disagreement will actually increase the trading volume. And then to some extent, actually, Answeiler and Frank demonstrates by using the data that they collected that actually disagreements can lead to trading failure. Okay, and then related to news, earlier I briefly talked about that. For news, usually it is in combination with textual analysis. So what happened is that people, they run some textual analysis on Wall Street Journal article and see whether the sentiments developed from the article can help to predict the stock returns as well as say the trading volume in the future. So what's find out is that they find that only negative sentiments, it works. It can help to predict, say, market trading volume, which is a work done by Tedlock, and they frame that kind of the phenomena as media pessimism. And again, like what I said earlier, they only find media pessimism works. And then for positive sentiment, actually it has limited effects to the market. So it seems to explain that people, they are kind of worried about, say, negative futures rather than a positive one. And then it makes sense because people, they are more averse of loss. So if, say, the general news media, they announce some pessimistic, say, articles, that it will actually make people more worried about, say, the future stock performance. And as a result, it will lead to, say, a very high market trading volume because people, they are scared, and then they may sell off their existing stocks to avoid some kind of the loss. Tedlock also did some kind of the research related to, say, the fraction of the negative words that appear in the news, and they find out that it can forecast, say, the future, say, stock returns. So usually, if there exists a large fraction of negative words, usually it is associated with low earnings in the future. And then there are also some, say, articles that are related to, say, media coverage. And then people, they find out that actually if stocks, they have more media coverage, then they usually have lower stock returns because there is a lot of uncertainty related to the stock. So if there is a more news exposure related to certain, say, stocks, investors, they get more information. And then what happens is that in terms of the stock returns, usually it is not as high as, say, stocks without media coverage. Because for stocks without media coverage, actually the uncertainty is very high. And then because of the uncertainty is very high, actually it may happen that people, they may overtrade or say undertrade the underlying stocks. And as a result, the returns of those stocks with no media coverage, they usually earn higher returns than stocks with, say, high media coverage. And then this is also some kind of the research in that area to study the coverage of media and also understand whether it can help to predict, say, the market returns or say the stock returns in the future. Okay, now let's talk about, say, some paper that are more related to, say, design science. So the name of design science, as the name suggested, it is to develop some kind of the trading algorithm, and then that can help, say, researchers or say investors to say do some kind of the automated trading and see whether it can get some gains out of it. So Jifa and Zahavi, actually they developed, say, a recommendation engine, and then what they do is that they actually automatically get some news from, say, some online sources, say, for example, Wall Street or say some social media. What they do is that they get in the news, and then they will they use some kind of the classification to classify how many positive, say, how many positive keywords or say negative keywords they observe on the pieces of the news. And then they can make use of the proportion of the positive and negative, say, sentiments they observe from the news articles and decide whether to, say, buy or sell certain kind of the stocks. So they build such kind of the simple, say, engine. And then they can use that kind of the recommendation engine and then recommend investors to, say, make some trading. And then they find out that it is possible to use that kind of the trading engine to automate some kind of the intraday trading. And they find some positive value of making use of that kind of the recommendation engine. And it is some of the, design science work that I would like to show to you, that you can make use of some of the research findings that we observed in the previous studies, and then actually realize it by building up some kind of the system that can facilitate people to do a better job in terms of, investment trading. Okay, and then earlier we talked a lot about, some of the traditional media. And then, for example, Wall Street Journal, and also you can use some kind of the sentiment analysis based on the posts of, and also the news of, traditional media. Actually, there is also a large body of literature on social media, stock prediction, as well as, firm valuation. So people, they make use of, textual analysis to understand posts posted on some of the social media, like Seeking Alpha. And then they can make use of the sentiment analysis results to predict, stock returns in the future. And some people, they also make use of some external, data, for example, web blogs, consumer ratings, or even Google searches, and also web traffics, to develop different kinds of the metrics, and then use it to predict the future earnings. And then what they find out is that for social media metrics, actually it is much more significant in terms of predicting, future firm equity value than conventional behavioral metrics like search and also the web traffic. So if you're interested to know more about that kind of the research, you can read, these two papers published in Finance and also IS, journals, and you can get some more idea about, the current research related to social media, and also, stock prediction and also firm valuation. Now let's get to the major body of this presentation. I would like to talk about search and also co-search. So basically, the first research that is related to search, it's published in year 2011 as a leading article in Journal of Finance. The author, Dar et al., actually what they do is that they make use of a Google search volume to measure investor attention. So what they find out is that a lot of the time when, investors, they if they're interested in certain kind of the stocks, the first thing they do is that they search online to fetch related information. Because Google is so ubiquitous, people, they usually use Google to search before they actually conduct any kind of, trading. So to some extent, Google search volume may reflect investors' attention to certain stock. Dar et al. Actually find out that by using the search volume data, they can actually predict the stock price in the next 2 weeks. So it demonstrates the usefulness of Google search volume in terms of predicting stock prices. Okay, so actually, for my paper, actually, I'm interested to look at not just search. I'm interested in co-search. In the subsequent slides, I will show to you what does it mean by co-search. Actually, co-search means that investors, they search 2 stocks at the same time. So I'm interested to know if, investor, they search multiple stocks at the same time, whether it can help us to make a wider range of prediction, not just predicting the stock price of the focal stock, but we can actually predict the stock price of a number of stocks that investors, they could search. And then I also have another paper that discuss how to build some kind of the prediction model based on the co-search attention data as reflected from the co-search activities of individuals. So in the coming second half of the seminar, I will talk about the 2 papers which is related to the search dynamics and how to make use of the search data to identify some kind of the opportunities to say develop a better prediction model. So the research motivation, it actually comes from the fact that usually people, they search before they actually commit to any kinds of say transactions. Of course, transactions can reveal some kind of the consumer preferences. However, they are inferior to say search. There are various reasons. The first reason is that transactional data happened after say customers have made up their mind and then committed to a transaction. And then what happened is that transactional data, it is historical. However, if we look at search data, actually it is more forward-looking. The reason is that because people search, they haven't yet committed to transaction. So if we can understand the search data in a better way, then we have a better chance to be able to predict what will likely to happen in the future, because search precedes transactions. And then actually a very famous psychologist Kahneman, who's a Nobel Prize laureate in economics science, actually suggests that people, they actually search something with objective in mind. They propose a theory of attention. And then based on the theory of attention, Kahneman suggests that people, they do not search randomly. They search with some objective in mind. So if we can collect all the search data, and then we can do some kind of say the data mining, and then understand the data in a better way. And to some extent, we can use the search data to reveal some of the future phenomena that we observe. And then in this say paper, actually what I'm interested to do is that to see whether the search say data can actually reveal some useful insights, and whether we can make use of the useful insights to build some kind of the prediction model. So first, let's say review some existing literature related to information search. So a lot of people, they actually talk about the usefulness of search. To some extent, it actually capture the footprint of say individuals, because by looking at the search data, then we can say predict what will be the likely say action taken by the user. So if you go to some shopping platform, usually they will give you some recommendations based on your browsing history. So why they're interested in your browsing history? Because they know that what you are likely to watch or what you are likely to buy in the future, it's likely to be similar to what you searched in the past. So based on your past searching history, then they can understand you more, and they can give you better recommendation that can meet your demand. So if a lot of people, they actually search online, and then we can base on their aggregate search data to kind of like predict certain kind of the demand. So say for example, if a lot of people, they search the forthcoming say iPhone release to be released by Apple, then we can approximately estimate the demand of say the new iPhone. And then if say you work for say Apple, then probably you can produce say certain sufficient amounts of say iPhone that can meet the market demand. In the past, actually, a lot of researchers, they actually make use of search data to make some kind of say prediction. Say for example, Wu and Bryn-Jobson, they use the Google search data to predict housing price in certain geographic location in the US. And Choi and Varian, they also make use of the Google search data to predict for potential unemployment rates in the future. And Dar et al., like what I said earlier, they use Google search volume of individual stocks to predict for the stock price in the forthcoming 2 weeks. And Luo et al., in their behavioral parametrics, they also make use of the search data to predict the forthcoming firm earnings. Now, one thing you have to bear in mind is that in the past, people, they only look at single item. They look at, the search keywords related to certain geographic area, search keywords related to a company. In the past, people, they only look at one single search. And in this research, actually, what we are interested in, it is not single search, it is co-search. It is looking at a basket of, say, keywords, a basket of items people they search at the same time. So the research question of this paper, it is to investigate what are the underlying characteristics of, say, co-search, and also what is the change in the attention that affects the search network, and how we can make use of that kind of the data to, say, predict for, say, future stock returns. Okay, before I go into the details of the research, I would like to, say, give you some idea about the research findings. So first, we find out that the co-search actually can reveal more granular user preferences, which is much better than, say, theories that are based on transactional data, because transactional data, it does not occur frequently, but co-search data, which I will show to you later, we can get the data on a daily basis. So it is more timely, and then it is more granular as well. And then second thing is that actually the underlying asset or, say, product network characteristics, they change with user attention. And more importantly, we can make use of, say, the search data in the past to predict for the future stock returns. Now, let's talk about, say, the co-search data that I use in the current research. So the co-search data that I collected, it is from Yahoo Finance, which is an intermediary, say, portals, very popularly used in the US. And I will show to you some screenshots later. So I collected the co-search data related to Russell 3000, which contains over 2,900 component stocks that represents, say, in terms of market value, 98% of all the investable, say, stocks in US markets. And the data that I collected, it is, say, 16 months of the data from 2011 to all the way to 2012. So all the stock data, they're collected from a database which is called CRISP. And then we also collect some supply chain related data from another database which is called Bloomberg. So here it is, say, a search page of Google. So if you go to, say, Yahoo Finance, and let's say you randomly type in some, say, stock, let's say Google, then you will be able to see a summary page like this one. And then actually we are interested in the also field page. So here we review some kind of the co-search data. So people who are interested in Google, they also look at Priceline, Amazon, Baidu, Apple, and then MasterCard, as well as say Netflix. So based on the data, we can actually generate some kind of, say, search diagram. So people who search Google, they also search 6 other stocks. And then we can basically expand the stocks by looking at individual stocks, say, also field page. So say, for example, people who search Apple also search, say, Amazon, Priceline, MasterCard, Microsoft, as well as, say, Chipotle, Mexican Grill, which is a restaurant. Okay, and then we can also look at, say, Amazon, and then identify the co-search or, say, the also field, say, stocks. And then we can use 1 month time period and then count the number of days such a search relationship exists. So if you look at, there is only one single arrow, it is, say, one-way search. If you look at, say, 2 arrow, it is, say, two-way search. That means people who search Google, they also search Amazon. At the same time, the majority of people who search Amazon, they also search Google, and it appears 30 days. Okay, so basically, we can make use of that kind of the data to, say, do some meaningful analysis. But as you can see that there are so many, say, numbers. So the first part of, say, the data analysis, it is some data screening. So we can actually screen out some, say, data or, say, some search relationship that are too thin, and then that may not represent, say, a persistent phenomena, and we can remove them. So say, for example, the relationship between Google and Baidu, it only appears 8 times out of, say, 30. and then we may consider it to be less than half a month, then what will happen is we'll remove that kind of the relationship. We only keep those relationships that are very strong, related to each other. And then also, as I mentioned, in this study, we are interested in co-search. That means that we are interested to look at bidirectional search relationship. So for those who are only search once, it is just some unidirectional search, then we remove them. So you may wonder why there exists some unidirectional search. It may happen that some small stock actually a lot of people, they are interested in, say, the small stock. They are also interested in some popular big stock. Say, for example, at the time when Facebook went for IPO, actually Facebook appeared on almost all other people's, say, co-search list. However, for say Facebook users, Facebook say investors, they only search a couple of other say stocks that they are interested in. So in that case, because Facebook is so predominantly appear in many small stocks, say co-search lists, and then we can infer that Facebook to those small stocks, it may have a huge impact. But for those small stocks, the impact on Facebook, it is not that much. So in that case, because we are interested in the co-search relationship, so we remove those say unidirectional search relationship from the diagram, and then we keep say cluster, which is what we call a cluster in the diagram, like this one. So they all exhibit say bidirectional search relationship, and such bidirectional search relationship, it exists for at least half a month over a 1 month time period. Okay, now I would like to introduce to you some concepts related to, say, a network diagram. So if there exists three components that are bidirectionally connected to each other, we have a name for it, we call it a clique. Okay, so Google, Apple, and Priceline, they form a clique. Earlier, I showed to you, say, Amazon, Google, Apple, they also form a clique. Okay, so by merging, say, cliques with overlapping members, we can actually form a cluster. Okay, so this is a cluster. And then if we look at, say, a search network based on the 3,000 stock data that I collected, it is something like this. Okay, by applying some kind of, say, the filtering, we can extract, say, some clusters like these two. Okay, so you can see that it actually exhibits different kinds of the characteristics for the formation of the cluster. So say, for example, this diamond-like cluster, they all represent, say, airlines. So say, for example, this is JetBlue, American Airlines, Delta, and also Southwest Airlines. This is United Airlines. Okay, so these are all airline company, and then they actually form a cluster. It makes sense because if people, they are interested to invest in airline, then obviously they will also search other say companies in the same industry, and then it forms say an industry related cluster. And then this cluster, it is more interesting because it consists of say companies in different say industry. So say for example, Nike, it is connected to Target. It is Target is a superstore, and then Nike is also related to McDonald's, which is a restaurant. Nike is also related to, say, Disneyland, and then Disneyland is also related to Walmart, say, for example. So this cluster, it consists of say different industry. So to some extent, it may be difficult for you to say use say industry as the only say factor to explain the formation of different cluster. So in order to understand the components of, say, different cluster in a better way, what we do is that we actually establish a similarity index. So a similarity index, it is to look at each component of a cluster and see whether they are similar or dissimilar. If it is similar, then we give them a 1. If it is dissimilar, we give them 0. So we can make use of, say, this similarity index and then understand the underlying, say, similarity, the pairized similarity of individual elements within a cluster. So what we can find out is that actually for, say, stocks within the same cluster, usually they are similar in terms of size. So usually if you search for big cap stocks, Usually, you also search for other big cap stocks. Value, which is say the growth ratio, the book to market ratio. So they have the similar growth value. So here, if it is 0, it means that completely dissimilar. If it is close to 1, it is very similar. So apart from say size and also book to market ratio, which is represented by value, we also look into industry. So we have say 10 industry classification by Farmer French. And then we also have 49 industries defined by Farmer French. We also see that the similarity is very high. And apart from say those say known categories in existing say finance theory, we also look into other say kinds of the characteristics. Say for example, the stock volatility, and then we find out that it is also reasonably high, which is much higher than value. So to some extent, it may imply that people, if they are interested to invest in stocks with certain risk level, because volatility, it measures certain kinds of the risk level, they are also likely to search similar stocks with similar risk level. So that's explain why the similarity index in terms of volatility, it is also very high. And then for some stocks, we also observe that if they exist some supply chain relationship, say for example, Intel and also say Lenovo, they are having some kind of a supply chain relationship, then their say similarity for that kind of the stocks, it is very high because they exhibit say supply chain relationship. And we also see that for some stocks, actually the supply chain relationship actually characterize the major reason for the formation of the cluster. But if we look at all the existing clusters, actually it is low. Apart from that, we also look into say the region of the headquarters. And then see whether, say, investors, they're interested to, say, search stocks in the same region. And we find out that actually for some cluster, they actually are formed based on region. So these are some of the new characteristics that are not documented in existing, say, finance theory. And we can make use of the search data to, say, enrich the existing one. Now, the second thing we want to know is that whether, say, the cluster that we established earlier, it is as good as the cluster established in existing finance theory based on, say, size, value, and also industry. So we can make use of, say, some of the existing finance model, which is, say, for example, capital asset pricing model, to, say, understand whether, say, firms within the same cluster, they demonstrate some, say, similar phenomena exhibited in previous finance research. So in previous finance research, what people would say is that if, say, people consider stocks to be similar, let's say they belong to S&P 500, they're similar to each other, then they exhibit some, say, similar, say, habitats. And then what happened is that the stock within the same habitats, they tend to move in the same direction in their stock returns. The reason is that because people, they all the time they listen to, say, collect news based on different kinds of the categories. So when they see the news related to S&P 500 all the time, then they pay equal attention to those stocks. And then what happened is that whenever some information happened to one stock in the habitat, all other stocks, they exhibit in the same way. So this is what we called in finance, what we called a co-movement. So in finance, actually, they use different kinds of the model to measure that kind of the co-movement. So if stocks that belong to the same habitats, let's say if they belong to S&P 500, then the stock return of the focal stock I, it should be correlated to all other stocks in the same habitats. Now, what we are interested to do is that we want to say replace the traditional definition of habitats by cluster. And we are interested to see whether beta 1I, it actually exhibits, say, positive and significant relationship to the focal stock I. Okay, we also control for, say, some non-market, say, indices, like what I say earlier, S&P 500, news, and also peer news, which is the news of other members in the same cluster. Now, what we are interested to look at it is beta 1. We want to see whether it is positive and significant. Okay, so in order to address some simultaneity issue, so what happened is that we form cluster in 1 month and analyze co-movement in another, say 40, say trading days. So it can avoid some kind of the simultaneity issue that may affect, say, the search and also the stock returns, behavior at the same time. And then we can also avoid the problem of firm-specific effects. So we run regression individually among all the members of stocks within the same cluster, and then we compute the average for beta 1, and then we compute the average after running individual regression, and then we use asymptotic theory to compute the robust standard error. And then we also use block bootstrapping to avoid the problem of serial correlation. So such an approach has been adopted in previous finance papers. So what we are interested in, it is the cluster. Okay, so we want to see whether the focal stock, they move in the same direction as other members' stock in the same cluster. So we see that it is a positive and significant. So if we look at S&P 500 stock, actually we also find out that, say, the focal stock, they move in the same way as the market in general. Okay, it makes sense because, when people in general, they feel positive towards, the market, then they will invest more. So it is also natural that it can move with, the market index as well. Apart from the CAPM model, we also run a Farmer French 4-factor model, and then we also see some similar results. So again, we are interested in the beta 1, and then what we find out is that the cluster can actually exhibit some kind of the co-movement phenomena that is documented in the previous literature related to habitats. Now you may wonder, is the cluster driven by some known characteristics? So say, for example, size, value, and also industry. So those are the 3 known factors in existing finance literature. Now, in order to alleviate that kind of the concern, what we do is that we identify some placebo stock that exhibits similarity with the same industry, similar in terms of size and also value. We want to see if we construct a fake, stock, whether that's, fake stock, which is another name we call it placebo stock. The placebo stock also could move with, the cluster that we identified earlier. Okay, so we're also interested in the beta of, the returns of the cluster. So we can see that actually it also could move with the cluster. But in terms of the magnitude, it is much smaller. Okay, so if you remember earlier, we showed that when we consider the focal stock, actually the co-movement, it is much higher in terms of, the value. And if we look at the difference between, the placebo, co-movement and also the actual cluster stock co-movement, we can find out that the difference, it is significant, which is like 0.43, which is very high in terms of the difference, which is a very high value. And then we can actually demonstrate that actually for the formation of the cluster, it is not purely driven by the 3 fundamental factors, which is the industry, size, and also value. Okay. Now, the second thing that we do is that we try to look at the dynamic results of the search cluster, because over time, people's search behavior, it may change. So this example, it demonstrates to you some of the changes in terms of the cluster. So in T1, actually, there exists 2 clusters. They are different from each other. People, they intensively search, Chipotle, and also Green Mountain Coffee Roaster, and also Travel Zoo. Okay, and then they search them frequently. And then Google, Amazon, and MasterCard, they are also searched frequently, but they are independent of each other. However, over time, what we observe is that people we observe that 5 stocks, say Google, Chipotle, Netflix, MasterCard, and also Amazon, they tend to be searched frequently Okay. And then some new stocks that are added to the new cluster. Say for example, Netflix, they're added to a new cluster. And some companies like Travelzoo and also Green Mountain Coffee Roaster, they are dropped out of the search cluster. Okay, so we observe some changes in terms of addition, deletion, and also switching. Okay, and then we want to see whether, the formation of the new cluster can also be used to help explain some kind of the co-movement phenomena we observe in the habitats, as shown in the previous finance literature. So again, we are interested to look at the change in terms of the co-movement, which is the beta value that we observed earlier. Before that, I showed you the results. I would like to let you know how many clusters they actually experience changes. So there are altogether 204 stocks that experience a cluster change, and then some of them they are related to the change in terms of the size, value, and also some of them they are related to change in terms of volatility, but not all of them can fully explain the formation of the dynamic cluster. So what we are doing right now is that we want to see whether as a result of the change of the cluster, firms they are in the recent clusters, they demonstrate a higher similarity in terms of the co-movement than the old one. Now, I want to before I show you explain the results, I want to let you know some of the phenomena observed in previous finance research. In previous finance research, what people find out is that if a stock it is delisted from some market index. So say for example, if one stock is delisted from SP 500, then actually people observe that in terms of co-movement, it's no longer co-move. The co-movement magnitude it is much smaller than before the deletion. The reason is that because the stock it is deleted from the market index, people they no longer pay attention to it because they think that stock it is no longer relevant to other stocks in the same habitats. So as a result, the co-movement magnitude it is smaller. So here in the dynamic analysis, we want to see whether we can observe similar phenomena. That is, the co-movement with the recent cluster, it is stronger than the co-movement in the original cluster. So we can find the difference between the co-movement in the recent cluster and the original cluster by computing the difference and see whether the difference it is significant. And then we can see that in the monthly analysis, in most of the cases, almost all the cases, the difference it is significant at 5%, except some few exceptional cases. So we can see that actually our prediction result is very good, and then our dynamic cluster it can actually captures the co-movement pattern as observed in the previous literature, where we only consider some static factors like size, value, and also industry. Now, the second thing we do is that we want to see whether we can make use of the research outcome to make some kind of reasonable prediction. So what we can do is that I would like to introduce to you some of the previous literature related to investment. We have a name for that phenomena, which is called style investing. So if people they are interested in certain kinds of stock, and then they will keep on investing it for a long time, and it creates a certain kind of the momentum which will last for longer period of time. So what we think is that if we observe the search behavior of certain stocks over a long period of time, exists for quite a number of months. So in this case, we study 6 months. So if it is being co-searched for a certain period of time, for a long period of time, then it's very likely that in the future, such kind of the search pattern will exist for a long period of time. And then we can make use of, the search dynamics in the past, half a year to predict for the returns in the coming month. And what we find out is that actually this is, successful, and we can make use of the search volume in the past 6 months to, kind of like predict what will be the likely, stock returns in the future. And we find out that the momentum exists. And then if, let's say, say stocks in the past, say 6 months, it performed well, and then people will keep on trading with the stocks, and then such a momentum will last for like at least 1 more month, and in the next month, the stock returns will continue to perform well in the future. And we also control for, say, a number of, say, known factors that will confound the results. Say, for example, say the lag value of the stock returns, the industry stock returns, and also the market capitalization of the stocks in the previous month, and also the price to book ratio in the previous month. We also control for the Google Trends, say, search folio, because those are known to affect, say, the monthly stock returns. Okay, so our result actually shows that it is quite good. If we look at, say, the returns of the, say, search cluster, we find out that it can positively predict the future monthly returns, significantly and positive. Okay, now let me talk about another paper which is also related to, say, cold search, and then it actually looked at whether the absence of, say, cold search attention among economically linked stocks, whether we can build certain kinds of returns predictability as a model based on it. And stocks with economic link, we analyze those stocks with supply chain relationship. Okay. Now again, the search data we collect, it is say stocks that appear in the CoView list of say Yahoo Finance. So say for example, if say people they are interested in AMD, which is chips manufacturers, which is similar to say Intel, they also look at say other companies like NVIDIA, and then also other competitors like say Intel, Dell, Cisco, and also Nokia. So we can see that some stocks they are actually in the same industry. Say for example, AMD and Intel, they're competitors. Both of them, they manufacture, say, processors or chips. Some of them, they are in the relationship of say, suppliers and buyers. Okay, so Dell is the major customers of, say, AMD, because Dell manufacture a lot of, say, personal computers that requires the use of processors. Similarly, Nokia, which is mobile phone manufacturers, it also use a lot of, say, processors from AMD. So Nokia is also, say, a major, say, customers of, say, AMD. So what we are interested to look at, it is to look at the dynamic. It is to say look at the dynamic relationship between, say, our focus stock and also its say suppliers and also customers. So say for example, for AMD, its major customers, as I said earlier, include Dell. They also include say Hewlett Packard. So Hewlett Packard HP is also one of the major customers, which say manufacture personal computer, cameras, tablets, etc. They all use say some of the say processors manufactured by AMD, and also at the same time AMD also buy from other say IT company. Say for example Oracle, they provide some kind of the IT services to say AMD. Similarly to say IBM, they also provide some kind of the services to say AMD. Okay, so what we are interested to look at, it is to say observe the changes of say the search attention of say the supply chain partners over time. Okay, so the gray line represents say the supply chain relationship. Okay, and then the thickened line actually represents the co-search attention. So if you look at the previous say page, actually Dell appears on AMD's co-search list. So the line, it is thickened, okay? On the date of, say, December 9th, 2011. However, some months later, on the February of 17th, 2012, actually, we observed that Dell is no longer on the co-search list of AMD. So what does it imply? It implies that investors of AMD, they do not pay attention to Dell. Okay, so there is a lack of say attention. So what does it imply in terms of our prediction? If let's say investors, they pay attention to both say suppliers and also customers, then it's likely that they observe the news related to both companies immediately, and then in their trading action, they will incorporate such kind of the news. So say, for example, if say Dell announced that they are going to say launch a new laptop, okay, and then what does it imply to AMD? That means that actually they will buy more from AMD. Okay. Similarly, if let's say Dell, they decide to say cut their production line, then what does it imply is that they are going to decrease the sales of their products. Then in the future, very likely that they will decrease the purchase of processors from AMD. So if say two companies, they pay attention to each other, then we see co-movement, which is what I showed to you earlier in the habitat view of say two stocks. If two stocks are companies say searched by say investors, then the stock price, they are likely to co-move. This is what we see, the co-movement. However, if say companies of investors of AMD, they lack attention to say Dell, then what happens is that they do not pay much attention to say events happen to the supply chain partners, and they may not be able to realize the implications of that news to the focal firm. So in the case of say Dell, say for example, in the early say year 2012, actually Dell made a positive announcement saying that its say laptop sales breaks a historical record. So Dell's stock price peaked in the say early 2012. However, AMD, it doesn't capture that kind of say the news, and you can see that in a similar time period there is actually some dip. They realize such kind of say the positive events only some weeks or say some months afterwards, because actually the two companies, they're economically linked. So the positive sales of say PC of say Dell, it will propagate to say AMD in terms of the news when say when Dell decide to say purchase more or say produce more say laptop, and then purchase more say processors from AMD, and AMD investors realize it. So you can see that in terms of the peak, the two companies actually they vary. One of the possible reasons is that the investors of say AMD, they actually lack say attention of events happen to them. So as a result, there is lacking behavior in terms of the stock returns. Okay, so for this paper, actually we asked two questions. One is that can co-search data actually reveal the extent of information diffusion? And then the second thing is that if there is an absence or say low co-search intensity, can we predict the returns of say supply chain partner? So in that case, what we are saying is that if there is a low co-search attention, can we use say the partners say return, which is Dell's past returns, to predict the future returns of AMD? Okay, so if we look at this chart, it seems to be possible. And then, of course, we need to use some empirical evidence to show it. So what we do is that we actually use some, say, cross-prediction model based on the partner's stock return, and also use it to predict for future stock returns. We follow, say, previous literature, and then control for, say, the focal stocks, say, lagged returns, industry returns, and also say we also make use of say the Farmer-French 4 factors to control for the macroeconomic factors that may also affect the returns of the focal stock I. So in this case, we use Dell's say past returns to predict for AMD's say future returns. That is the objective of say this whole paper. And then apart from say the macroeconomic factors, we also include the number of analysts, and also we include say the institutional holders, which are also known to say affect say the returns of say a focal stock. And then we use say standard error with cluster at say firm and week level when we compute say the prediction level. So what we do is that actually imagine that in each say week, we use week as a level. What we do is that we check whether the supply chain partners, they have a high co-attention or say they have a low attention. Here we divide say all the stocks into two groups. One is with high attention and another with say low attention. And then we run say the cross prediction model as illustrated earlier. Now, if low prediction, if low co-attention can lead to better prediction results, then we should observe that say beta 1, it should be significant and positive. If it is not true, there is no predictability, then beta 1, it should be not significant. Okay, so let's see the results. So we find out that actually our earlier hypothesis, it is true. If say there exists a low attention between say supply chain partners, then actually we can use the partners' returns to predict for future returns of focal stock. But the similar case does not apply for high attention because as I mentioned earlier, high attention stock, they co-move together and there is no lagging effects. And as a result, we cannot see the prediction power. Okay, and then we can construct a trading strategy and we collect all the stocks based on the partners, say stock returns. So one thing we can do is that we can classify them into different decile. So decile 10, it means that the partner stock, they experience the highest change in terms of the stock returns. D1 is represents the partners with the lowest, say, returns. And then we use it to say predict, say the future stock returns of the focal stock. So F stands for focal stock. So if let's say there exists say low stock returns of partner, then what will happen is that in the future the focal stock returns, they will exhibit a similar phenomena. So if let's say we buy those say focal stock whose partner in the previous week that experienced the highest most positive change in terms of the stock returns, then we should experience gain by the end of the current week because we buy, say, the focal stock, and then the information of the good news of the partner diffuse slowly to the focal stock, okay, because they have no co-attention. So if we buy in the beginning of the week of, say, all the focal stock in decile 10, then by the end of the week, we should experience the positive gain. Similarly, if let's say we know that the partner in the past week it experienced say the most negative say returns, then if we sell the stocks of say the focal stock of the partner, then we can actually realize the most positive gain. So the strategy is that we buy decile 10 focal stock in the beginning of a week and sell decile 1 focal stock in the beginning of the week. By using this strategy, we want to see whether we can get the most significant, say, portfolio returns, which can beat the market. So we are interested in alpha in the regression model. So alpha actually represents some of the, say, returns that cannot be explained by existing market factors. So other market factors include, say, the market, say, composite returns, and also some of the non-farmer fringe factors that control for the macroeconomic environment. So if alpha, if it is significant and positive, that means that the portfolio that we construct, it can actually beat the market. If it is negative, that means that it underperforms. It is worse than, say, investing by just buying bonds because it, say, follow, say, the market, say, fluctuations. If alpha, it is not significant, that means that your portfolio, it is, say, just so-so. It is similar to, say, trading some say some random stocks that follow the trends of say the market development. So let's see if alpha by using this kind of the trading strategy is positive and significant. Okay, so if we look at the trading strategy I described earlier, if we consider stock, say supply chain stocks with a low co-attention, actually we find out that alpha, it is significant and positive. That means it can beat the market. Then it demonstrates that, say, the predictability is high if the supply chain partners, they have low co-attention. However, if the partner, they have high co-attention, and we use, say, the strategy illustrated above, alpha, it is not significant. It is just a so-so performance, okay? And then we also, say, do some kind of, say, the baseline analysis. Let's see. And the baseline analysis is that we just say trade some stocks say based on the market value, and then we can find out that say it again. For the baseline method, what we do is that we just ignore high and low. Okay, we just trade among the say stocks with say the supply chain partner relationship. We do not consider high or low co-attention, and then we use the same trading strategy. What we find out is that in terms of the alpha, it is less in value, and also it is only significant at 10%. If we look at the trading strategy that focus on low co-attention, actually the alpha is significant at say 5% level. And then we can see that there is a much say better improvement in terms of the alpha, and the improvement it is say 22% if we consider the difference between low and also baseline. And then we can also say that such kind of the portfolio trading on the low co-search attention, it can help the markets to increase say the gain by 10% annually, which is actually quite high. So in conclusion, actually in this say research, we shows that search can be used as a proxy for co-attention. And then more importantly, we can make use of the co-search intensity to say build some kind of the cross prediction model among stocks with say a cross prediction supply chain relationship. And then our trading strategy by considering the partner stocks previous stock returns, and then trade focal stocks accordingly, it can lead to say high stock returns. And then more importantly, actually we show that we can make use of the data in intermediaries to say derive some useful information, and it can say enrich existing literature related to information search, stock prediction, as well as say stock market value. So that's the end of my presentation. If you have any question, please feel free to let me know. You can unmute yourself or you can type on chat. So please feel free to ask me if you have any question.
好的啊，非常感谢这个Alvin梁教授。那个，对，如果有问题的话，可以这个在聊天室当中提问。我的推荐方式是首先在聊天室当中提问。
Yeah, I see a hand. 真言 please ask.
对，这个我看一下啊，我看一下怎么弄哈，我还没弄过。现在是什么？现在是静音是吧？请求解除。我看这个我倒还没有弄过这个事情。我怎么样解除它的静音呢？那个颜真，你可以自己解除静音吗？
Maybe let me answer a question on chat. So a question is, shall I know where can you download the search index of stocks from Google? In fact, I think for Google, it doesn't show the co-search data. The data I collected, it is from Yahoo Finance. So for Yahoo Finance, actually what I do is that I actually write a crawler. And then the crawler will actually go to, say, Yahoo Finance web page, and then it will actually collect the HTML file. And then by using some kind of the, say, text processing, I will extract, say, the also field list. So actually, I collect the data by using a crawler because such a data, it changes, say, every day. And then also, I think Yahoo doesn't provide that kind of the data. So I use a crawler to collect the data. For Google, I think Google doesn't provide that kind of the information. Yeah. Or maybe are you talking about, say, the Google stock page that I showed in the example? I think earlier in the example, I showed, say, the Google example. Yeah, this is, say, the Google stock that I collected from Yahoo Finance. So on Yahoo Finance, I type, say, Google, and then I figure out, say, the also search list of Google. And I actually use a crawler to, say, download all the data. And then for some intermediaries, apart from, say, Yahoo Finance, some intermediaries like Sinan Finance also has some kind of the data like this. And actually, Chen Xi and I also have a paper. I think it is conditionally accepted. It is also making use of the co-search data in Sinan Finance. And we actually developed some kind of, say, index for the sake of, say, stock prediction in, say, China markets. There's a follow-up question. I would like to know how we can download the search index on co-movement stock only. For the search index, actually, you need to, say, do some kind of, say, data, say, manipulation. So as I said, say, earlier, actually, first, what I need to do is to, say, download individual stock. So the individual stocks consist of, say, Russell 3000. So Google is one of the Russell 3000. So what I do is that I collect all the search data related to, say, the Russell 3000 stock. And then what happened is that I construct, say, a search diagram based on the daily data that I collect, and then based on the time frame that I analyze. So in this case, I use 1 month to, say, do the analysis. So what I do is that I actually form the clusters, and then it needs some kind of the data processing. So it is not straightforward for you to, say, just download the search data from, say, Yahoo. You need to, say, collect the also field data, and then do some kind of the processing, and then be able to, say, get the say, the search index data, build a search index data on your own. So another question is that, do you record this data yourself every day? Yes, actually we use a web crawler to, say, download all the data and then process it on a regular basis. So actually it has to be processed by the researchers. And then the index data, it is not, say, downloadable by or, say, publicly downloadable from, say, the repository. Yeah, so we have to, say, analyze the data on our own. Yeah. Feel free to ask if you have any other question. Oh, there's a question about what is FF10. Okay, so FF10 stands for Farmer French 10 Industries. So there are lots of, say, firms existed listed in the US. And then to facilitate comparison of firms, it is easier to, say, group firms according to industries. So there are different kinds of, industries that can be formed. And then Farmer French, there are two US researchers. And then actually Eugene Farmer is the Nobel Prize laureate in year 2013 in economic science for his, outstanding achievement in, finance. And then what happened is that some researchers, they will classify firms into different industries. So Farmer French, they actually classify all the US firms into 10 different industries based on their, industry code that is being assigned by, the US, Statistics Bureau. And then some people, they find out that, okay, 10 industries, maybe they are too few. And then what happened is that Farmer French, they also expand the industry classification to say 20, 30. The largest, industry classification, it is 49. So what they do is that they look at the standard industry classification of each firm, and then they map each firm with similar characteristics together, and then they form individual industry. So 10 industry, it means that they classify all the US firms into 10 different industry. And then they have, a detailed, ways of classification based on the standard industry code assigned to each individual firm. So if you're interested to know more about the details of, the Farmer French industry classification, you can go to Kenneth French website. All the industry classification data, they are readily available. And then you can download the industry classification data. And then you can also download the data related to the Farmer French 4 factors. So earlier, I think I showed some of the 4 factors. Let me see if I can find, oh yeah. So say for example, the market risk factor, the size risk factor, growth risk factor, and also the momentum risk factor. And then the data are also available on Kenneth French's website. And then if you are interested to know the classification in details, as well as download other related Farmer French factors, you can go to Kenneth French, which is the second author's website, and then you can download all the related data there. Okay, there's another question. Regarding the prediction accuracy, I found out you are doing return. How if someone query about prediction accuracy where there are so many factors such as predictions, models, and goodness of fit or measurements being used in confirming the prediction forecasting accuracy? How would you explain to them if someone is wondering the accuracy claimed by us in our study? Okay, very good. So basically, there are different ways for you to measure the accuracy of your prediction model. But I think one key thing is that you have to use some data which is out of your training sample data. Here we use some outsample data that is different from the data that we use to train our model. And then we use the outsample data to do some kind of, the prediction. And then the prediction outcome, it is, the portfolio returns. And then by analyzing the portfolio returns, then we can more accurately to convince, even layman that actually our trading strategies works. Because sometimes for some, non-academics, they may not know very clearly what does it mean by, goodness of fit, R square. So here we use a more, simple approach to conduct some kind of the simulated trading. So if you refer to the slides, I actually conduct some kind of the simulated trading. Yeah, I developed some kind of the trading strategies. So the idea is simple. We just look at the portfolio returns. Okay, look at the portfolio returns and then tell them that actually the portfolio that you generated by using your trading strategy, it can generate a significant and positive alpha. Then it can convince even layman that actually your trading strategy works. So sometimes you may have to use some method that is easier to explain. And I think trading strategy by using some outsample data to demonstrate the effectiveness of your trading strategy. I think it is the best way to show your trading strategy is working. Let's see. So someone ask whether it's possible to download your my PowerPoint. I think I shared the PowerPoint with the committee. So if you're interested, you can ask the organizer of the committee. I believe they can share it with you. I think it's okay. There's another question. As illustrated in the second paper, we can use lag partner returns to predict the future return of the Focal stock. But I wonder whether the lagging effect is only between a company and its supplier. Like we can use a stock price of Dell to predict AMD, but the converse may not work. Yes, that's true. So in our case, we only use the example of companies with economic linkage. That means they are having, supplier and also buyer relationship. And also at the same time, we check whether there exists some of the low co-attention intensity. So in the example that I mentioned earlier, we use the stock price of Dell to predict AMD. Whether the reverse it is true or not, I need to look back at my data and see whether AMD appears on Dell's, co-search network. If it doesn't, then the reverse can also work. And then for the paper, actually, we only focus on firms with economic linkage because it's easier for us to explain why we can make use of the lag returns of the Focal firm's partner to predict the stock returns, stock price. For that paper, we only restrict it to, economically linked, stocks. But another paper that Chen Xi and I work on, actually, we extend, the study to all other firms. By building some kind of search index, and that can be applied to firms even though they are not with any economic relationship. So the concept actually can be expanded to other firms, but in the paper that I demonstrated to you, it is only among firms with a supply chain relationship.
Okay, thank you, Alvin. Thank you for all the attendance to listen to this lecture, and let's give our silent applaud to Alvin to thank him for the very interesting and very excellent